Welcome all, Abhilash here. This is second session on the unit 5 that is talking about the financing. So in this session I am going to talk on long-term financing. So as we know we have two sources of finance. First is short-term finance and second one is long-term finance. So short-term finance we have discussed in the last session. So let me recap again. The short-term finance, the finance which is taken the loan from the bank for the year. Okay, the loan term is not crossing the 1 year line. Okay, the short term finance, the in the short term finance the borrower takes a loan or he takes a money from a IPO to expand his current operation of the company for the short term period. The long, Next is long term finance. Long term financing is a form of financing that provides for a period of more than 1 year. In the short term finance the loan is provided for the 1 year only, but in the long term finance is a form of financing that is provided for a period of more than a year. Long term finance can be defined as a financial instrument with the maturity extending 1 year, such as bank loans, bonds, leasing, and other forms of debt financing, public and private equity instruments. So maturity refers to the length of the time between organization of financial claim like loan, bond, and other financial instrument, and the final payment is debt, at the which point the remaining principal and the interest are due to the paid. Purpose of long-term financing: to finance the permanent part of working capital and to finance the growth and expansion of the business. If borrower wants to expand his business, then he will opt for the long-term finance. Factors determining long-term financial requirements: nature of business, nature of good produce, and technology use. So these two factors are determining the long-term financial requirement. Extending the maturity structure of a finance is often considered to be at the core of sustainable financial development. Long-term finance contributes to faster growth, greater welfare, shared prosperity, and the enduring stability in two important ways. By reducing rollover risks for borrowers, thereby lengthening the horizons of investment and improving performance, and by increasing the availability of long-term financing instruments. So thereby allowing households and firms to address their life cycle challenges. The term of financing reflects the risk-sharing contract between providers and the users of finance. Long-term finance shifts risk to the providers because they have to bear the fluctuation in the probability of a default and the other changing conditions in the financial market, such as interest rate risk. Often providers require a premium as a part of the compensation for the higher risks this type of financing implies. On the other hand, short-term finance shifts risk to users as it forces them to roll over financing constantly. So sources of long-term finance. So we have a company or borrowers having the this much of sources for financing the long term: shares, debentures, retaining earnings, term loans, deferred credit. So now let's discuss shares, debentures, and all things by one. So shares, a capital of a company is divided into small units. Each unit is called shares. Issue of shares is the main source of long-term finance. Shares are used by joint stock companies to the public. A person holding shares is called a shareholder, and investors are of different habits and temperaments. Shares, equity, and preference. In the shares, we have two types: shares, equity, and preference shares. Equity shares and preference shares. So now, what is the equity shares? Equity shares are those shares that do not enjoy any preferential right in the matter of the payment of a dividend or repayment of capital, not fixed rate of dividend. So in equity shares, you might have heard about the equity shares in the stock market, which company is offering at the certain price where you can buy that particular stock in your demat account, right? And there is no fixed rate of dividend. There is not a fixed rate of dividend. You might whenever company is declaring the dividend, that time you will get to know that how much dividend you are receiving for your per stock. Continued right to take part in the management of the company. So whenever company is conducted AGM, that is the annual general meeting, company will mail you the dates and everything. There you can part your there you can part the there you can become a part of the management meeting. Carry more risks, equity shares, yes, that is the right thing. In equity shares there is a more risks involved. Preference shares. Preference shares are shares which carry preferential rights over the equity shares. The rights are receiving dividends at a fixed rate. So in the preference shares, the borrower or the investor uh, will get dividends at the fixed rate, getting back the capital in case of the company is wound up. If company is declared default, then company will wound up and the preference shareholder will receive his capital which he has invested. Investment in these shares are safe and the preference shareholders are also get dividend regularly. So investment in preference shares is always considered as a safe and with the fixed rate, the investor will receive the dividend as well. So as compared with the equity, in equity there is a risk involved. If company wind up, the investor will lose the fund, he will lose the capital, and there is no rate fixed for the dividend. Type of preference shares: cumulative or non-cumulative, remediable or remediable, participating and non-participating, convertible and non-convertible. So cumulative and non-cumulative. The holder of cumulative preference shares are entitled to recover the areas of preference dividends before any dividend is paid on equity shares. In case of non-cumulative preference shares, areas of dividend do not accumulate and hence if dividend is to be paid on the equity shareholders in any year, dividend at the fixed rate for only 1 year will have to be paid to preference shareholders before equity dividends is paid. Note, unless specifically mentioned otherwise, preference shares should be considered to be cumulative. Redeemable and redeemable preference shares are those preference shares whose amount can be returned by the company to their holders within the lifetime of the company subject to the terms of the issue and the fulfillment of the certain legal conditions laid down in Section 80 of the Companies Act. The amount of irredeemable preference shares can be returned only when the company is wound up. Participating and non-participating. Participating preference shares are entitled not only to fixed rate of dividend but also to a shares in surplus profit which remain after dividend has to be paid at a certain rate to the equity shareholders. So participating and non-participating, this shares option you might get when you are buying the life insurance policy. That time they will offer you some dividend, they will offer some bonuses, they will offer some participation products where you will get more options to select the insurance. The surplus profits are distributed in a certain aggregate ratio between the participating preference and shareholders and the equity shareholder. Non-participating preference shares are entitled to the only fixed rate of dividend. Convertible and non-convertible. The holder of convertible shares enjoy the right to get the preference shares converted into the equity shares according to the terms of issue. If the investor is holding convertible shares, he can convert his preference shares into the equity shares. The holder of non-convertible preference shares do not enjoy this right. So they don't have the right, they just have to hold their non-convertible shares as a preference shares. Debenture. So debenture is a medium of a long-term debt instrument used by large companies to borrow money at a fixed rate of interest. Issues of loan certificate given to public. Debenture holders have no rights to vote in the company general meeting as compared with the dividends holders like preference shareholders who has a rights to attend their general meeting and who can put their thought, but in the debenture holders have no rights to vote in the company general meeting. Issues under the common seal of the company. The whatever decision might have taken the AGM that issued under the common seal of the company. So this type of tickets, this type of debenture from the debenture holders are receiving. So right now everything we have electronically, like you will receive e-soft copy. Characteristics of debentures holders are the creditors of the company. Holders do not carry voting rights. Debentures are secured and debentures are repayable after a fixed period of time. So debenture secured. Why? Because in the debenture you will receive your full money if companies wind up, and the company is giving fixed interest rate. Renewable debentures. So these are debentures repayable on a predetermined date or at any time prior to their maturity, provided the company so desires and gives a notice to that effect. Renewable debentures. They are also called perpetual debentures. A company is not bound to repay the amount during its lifetime. If the issuing company fails to pay the interest, it has to redeem such a debentures. Convertible debentures. The holders of these debentures are given the option to convert their debenture into equity shares at a time and in a ratio as decided by the company. Non-convertible debentures. These debentures cannot be convert into equity shares. It's same like a preference shares. Non-convertible preference shares. Retained earnings. This is one of the third type for long-term financing. The portion of the profits which is not distributed among the shareholders but is retained and is used in business is called a retained earnings. Likewise, let me give the example in the stock market. Like I was holding the Ashok Leyland shares where they didn't give the dividend for the 1 year. So what they did, they retained their earning. So they didn't distributed their 1 year profit into the shareholders among the shareholders. So they retained their earning and they used that earning in the business. As per the Indian Companies Act, companies are required to transfer a part of their profits in reserves. The amounts so kept in the reserves may be used to buy fixed asset. This is called internal financing. So is subject to the internal financing. Term loan. One more type for long-term financing. A term loan is a monetary loan that is repaid in a regular payments over a set period of a time. Term loans usually last between 1 and 10 years but may last as long as 30 years in some cases. Term loans is a loan made by a bank financial institutions to a business having an initial maturity for more than 1 year. Deferred credit. A deferred credit could mean money received in advance of it being earned, such as deferred revenue, unearned revenue, and customer advances. A deferred credit could also result from complicated transaction where a credit amount arises, but the amount is not revenue. A deferred credit is reported as a liability on the balance sheet depending on the specifics. The deferred credit might be a current liability or a non-current liability. In the past, it was common to see non-current liability section with the heading. So deferred credit, why it's considered as a liability? Because deferred credit is the advance payment which taken from the customer without selling or without giving any product. So that's why it's considered as a liability on the balance sheet. So this is all about long-term financings. Thank you. Best wishes.